The merger of Churchill, CCIV, and Lucid was one of the most highly anticipated of the year, and it has sparked a lot of investment interest among those looking for a serious competitor to Tesla. Because it is public, investors are concerned about the possibility of a stock split and how it would affect them. Today, we'll look at whether there are any possibilities for a prospective stock split. How will it affect investors? We'll go over the advantages and disadvantages of stock splits, as well as the latest news around it. Welcome back to New Vehicle Media, where we discuss electric vehicles and their stocks. Subscribing's free, and liking helps YouTube to understand your preferences. Comments are loved and get featured in future videos. The merger. Lucid Motors has agreed to merge with Churchill Capital 4 Corp., a special-purpose acquisition firm, to become a publicly traded corporation in the largest deal ever between a blank check company and an electric vehicle startup. The combined business will have a transaction equity value of $11.75 billion, with Saudi Arabia's sovereign fund remaining the largest stakeholder. The public equity deal's private investment is valued at $15 per share, implying a pro forma equity value of $24 billion. Churchill Capital and Lucid Motors will be called Lucid Group as a result of the merger. Furthermore, the CCIV stock ticker will be replaced by the LCID stock ticker. As a result, CCIV shares will be delisted from the New York Stock Exchange on Monday, the 26th of July, and the company will be traded under the new ticker on the NASDAQ exchange. Lucid CEO Peter Rawlinson, along with the rest of the management team, will continue to run the company after the acquisition. Churchill Capital's management team will provide them with industry knowledge and connections. Following the merger news, CCIV stock experienced a lot of trading on Friday, the 23rd of July 2021. More than 9 million shares of the stock have changed hands as of this writing. This is approaching the company's daily average trading volume of 12.5 million shares. The stock was up 1.7% in the afternoon, giving it a year-to-date gain of 131.6%. That's definitely attention-grabbing figures for the investors. That's why since going public, the company has gotten a lot of attention from investors. When rumors of a possible merger first surfaced in January 2021, the public was keen to know whether or not there would be a stock split following the merger. We already know how the stock split affected the competitor, that is, Tesla. Both the Lucid and CCIV communities are actively showing the excitement, where the public has been asking the topic since February 2021. Some of you might be scratching your head about what stock splits are exactly, and why the companies are going for the stock split. Don't worry, we got you covered. Stock split. Every publicly listed company has a defined number of outstanding shares. A stock split occurs when a company's board of directors decides to expand the number of existing shares by issuing more shares to present shareholders. The new issue is in the form of division, where a firm divides its existing shares of stock into many new shares in order to increase the liquidity of the stock. The split adds no real value. The overall dollar worth of the shares remains the same compared to pre-split amounts, even while the number of shares outstanding grows by a specific multiple. A 2-for-1 stock split, for example, provides an additional share for each share held by a shareholder. So, if a firm had 10 million shares outstanding before the split, after the 2-for-1 split, it'll have 20 million shares outstanding. In simple terms, consider a $100 bill that has been modified or split into two $50 bills. In this scenario, we'd call it a 2-to-1 split. Alternatively, a $100 bill might be split into 5 $20 bills, resulting in a 5-to-1 split. Some might be wondering, why go for the stock split when, in reality, it adds no value to it? Those thoughts are considerably wrong. Whenever companies believe that their share prices are excessively high or beyond the price levels of similar companies in the same sector, they go for stock splits. The reason for this is that a stock split can appear to small investors as more reasonable. When a stock splits, it might result in a gain in share price, even if there is a drop in the stock price right following the split. This is due to the fact that small investors may see the stock as more affordable and hence purchase it. This effectively increases stock demand and raises pricing, and that's what happened to Tesla's stock price as it dropped after the stock split. But since the demand increased, it bumped up their stock price. Tesla stock split. Tesla stated after the market closed on August 11, 2020, that its board of directors had approved a 5-for-1 stock split to make stock ownership more accessible to employees and investors. This was Tesla's first ever announcement of a split. The stock rose from $1,374.4 before the split to $1,585 the next day, before settling at $1,554.75. Tesla continued to rise throughout the month, reaching an all-time high of over 80% by the end of August 2020. Tesla stock lost much of its August gains in just a few trading sessions in early September after the split was effected. This makes sense given that the goal of the split was to give shareholders more liquidity over their Tesla holdings. Tesla's stock price has fallen from its peak earlier this year, but it's still substantially higher than it was after the split last year. Tesla is currently trading at $643.38, up 29% from the $498.32 closing on August 31, 2020, the day of the stock split. The conclusion. Nonetheless, even in today's investing climate, when platforms allow for fractional share trading, there are still advantages for stocks with lower pricing. One clear benefit is the psychological influence, as low prices are viewed by the mind as cheaply valued, and having the potential to move up in the market and realize the potential gains. When it comes to the question of will Churchill and Lucid go for the stock split, we can only forecast it by doing a comparative analysis with the companies in the same industry, in essence with Tesla, who went public on June 29, 2010, and was traded on the stock exchange at $5.16. Tesla did not go for a stock split as the stock was already liquid. After years of operation and financial success, the stock rose, and Tesla announced a stock split in August 2020, 10 years after going public. We can expect something similar from the recently merged companies in the near future. The company stock is currently trading at $24.25 a share, which is 4 to 5 times more than that of Tesla's stock when it went public. However, the merger is still new, and Lucid has yet to make an impact in the electric vehicle market. Although a stock split is unlikely in the near future, there's no denying that we could see one if the operations run smoothly. If investors want to hold CCIV stock, they should not wait for a stock split. It's possible that it won't happen, and the stock price will continue to rise as a result of speculation, increasing sentiment, or company fundamentals. These are some of the reasons which makes it hard to believe that there will be any stock split for Lucid and CCIV in the near future, or at least in the coming 3 to 5 years. Of course, you're free to hold a different viewpoint. In that case, we would love to know more about it. Fernando thinks Lucid share prices will compete with Tesla in the near future. Do you agree? What do you hope to see from the company now that it's gone public? Do you believe there's a likelihood that the stock split will take place? That's all there is to today's video. Don't forget to subscribe and hit the notifications button so you'll be notified every time we release a new video. There will be a lot more interesting content to follow. You don't want to miss out on any of those videos. Thanks for watching.